All right, good Sunday afternoon, everybody. Hope you're staying warm. It's got to be tough because I'm here in Florida, north central Florida, and it's right now it's about 40 degrees. This morning I woke up, it was 22 degrees. Florida. I mentioned Florida, right? So I can only imagine what it is in the northern parts of the United States right now. So be safe, bundle up, and weather the storm, as they say. It does actually warm up to about 70 by the end of this week here in north central Florida. So can't wait for that because I do not like this weather. I petitioned in Florida a long time ago that there should be a law. It doesn't drop below 65 degrees, but hasn't worked. Anyways, um, so we're going to dig in to the Phenom Group weekly macro market research report here. Just go over some key points of interest. Maybe if we have time, look at some other subject matter. But main objective here is just kind of see where we at in the markets. Maybe what I think is going to happen going forward, as well as what you should be doing. At the end of the day, it doesn't matter what podcast you're viewing as part of your weekly regiment. If it's not practical, if it doesn't have utility, if it doesn't move you to act, you're wasting your time. And I'm not in the business of doing that on podcast or off podcast. You may have recognized that about me, and if you follow me on X, like all I care about is what I can do. I don't care about the stuff that is um, that doesn't lend any practicality to managing my portfolio. So with that, a couple weeks ago, and speaking of X, I did post this on X. I'll read it. What happens when you're 100% above the 200-day moving average? The sad thing is, no matter where the concentration, this is a chart of silver, and as you can see, it has doubled the distance from its 200-day moving average, i.e., it's 100% off of its um, 200-day moving average there. So the sad thing is, no matter where the concentration, it always ends with the need for liquidity and the liquidity getting pulled from equities. That was on the 18th. I posted that when silver and gold were still just going higher and higher and higher and higher. And this just never ends well. This kind of parabolic move never ends well. And so on Thursday, we saw both gold and silver peak and have just a massive outside reversal. Taking both, giving up all the gains in those asset classes, but in doing so, it was understood that there was a lack of liquidity in the complex. So where do you get the liquidity from? Exactly, you pull it from equities. If broker dealers, if market makers need to raise cash for the brokerage to offset some of the inbound orders or satisfy those inbound orders, then they've got to start selling off equities. And so that's why you saw equities down massively in tandem, like it was almost, step for step around, 10 o'clock, 10:30, when gold and silver started taking, equities just kept sliding. There was like no bid. They just kept falling until about 11:30. And so that you can trace what's going on through intermarket analysis. But when they say, well, you couldn't have known. Oh yeah, you could. I've got 25 years of experience in this business, folks. I know what to look for. I know what's going to happen next. You get parabolic moves like this, and they're going to unwind, and it's always going to have an impact on the equity market. And that's exactly what happened on Thursday and carried through Friday. Don't be surprised if there's some more follow through come Monday's open market session, as we're starting to see also liquidation take place in the crypto complex over the weekend. So these are just the things to be aware of. the beautiful thing about it is if this is what, equities pull back or consolidate because of, and it is at least in part the reason why Thursday and Friday equities were down. Good. Like you want equities to go down for stuff that's not related to the economy, not related to earnings growth. If it's something, nuanced like intermarket analysis and the need for liquidity to satisfy what's going on in the metals complex in crypto, good. I mean, that's a great opportunity. All other things created equal, right? Earnings still being revised higher for not just the Q4 period, but 2026 as a whole. The economy still humming along, if not accelerating to some degree. Like that's as big a buy the dip signal as you can get. Because equity is going to rebound when this whole episode, if you will, this unwind in metals and crypto normalizes to trend. Equities are going to get their bid again. So this is actually good liquidation or a good hunt for liquidity, a good pullback in equities. And, just gold miners here, as you can see, have just big reversal and Thursday and through Friday session there. When we talk about it happening over the weekend here now in Bitcoin, we can see this is the Larry Williams cycle forecast for Grayscale Bitcoin as a derivative, if you will, of the Bitcoin complex or the crypto complex. And the cycle forecast for 2026, you can see, the gray line turns into the darker shaded line. And it basically calls for a nonstop downtrend that lasts into February, possibly troughing there in March before establishing a new uptrend. Now, the important thing to recognize when it comes to these types of cycle forecasts, and it doesn't matter what complex it is, it's a cycle forecast. The exact trend is not the magnitude, the depth, and then the peaks and whatnot. That's not supposed to be your guide. It's a matter of following the trend. The peak, or I should say, the trough may happen here in February, and certainly it might happen here in March, or it could extend to April. That's why the path is more important than the magnitudes. Where the troughs and peaks can be very different from the actual forecast. But in terms of accuracy, it's hard to deny the Larry Williams Bitcoin Trust cycle forecast to date so far, right here in the calendar year. And so what we see through the weekend is a big decline. Let's go to CNBC. We can pull it up real quickly here. I've always got it on my frequented list. Bitcoin. And you can see where, oh, well, now it's showing up 186, but this is down a good 6,000 from Friday. About 6,000 to the downside from Friday. So big liquidation through the weekend here, folks. In my opinion, if you've been longing to, try out, so to speak, the crypto complex, this is probably one of your better opportunities. There's been some strategists out there. I don't want to name names. Doesn't mean I won't. I just don't want to, but I will. There's been some strategists out there that have said, "Oh, there's no such, the 4-year cycle is no more." For which I say, wow, how convenient, right? You've got a bullish call on Bitcoin or you got a bullish call on ETH. Where are we? For 2026, and being that Bitcoin and cryptos have been in consolidation basically since November of last year. You're deciding that there's no such thing as the 4-year cycle anymore. I had posted this chart way back in October of last year, evidencing the 4-year cycle of Bitcoin in US dollars. And what I also recognize is that both of the because there's only been 3 cycles. When we talk about Bitcoin, it really only goes back to 2013, 2014. So it's 3 cycles. Like, I get it. If you want to say there's no such thing anymore as a 4-year cycle, we had a small sample size to begin with. So what are you really saying? Tom Lee, Cathie Woods, right? Some of the more the louder voices when it comes to the crypto complex and having rather elevated prospects, if you will, for Bitcoin prices, Ethereum prices, so on and so forth, right? For them to come out at the beginning of this year saying that they don't think that the 4-year cycle is a thing anymore, I thought that was rather convenient of them with their bullish takes or bullish outlooks for the complex. Having said that, what we recognized within the 4-year cycle is that each year one is a midterm election year, 2018 and 2022, which means 2026 is also the third year one and a midterm election year. Now, both midterm election years found a greater than 50% decline in Bitcoin price. Excuse me. So the fact that we are now down from the all-time highs, almost, not quite, we'd have to get into the 60,000s for Bitcoin pricing to satisfy a 50% decline from the all-time high. But this is in keeping with the 4-year cycle. This is the expectation, right? I mean, don't get me wrong. I didn't think that we would fall this much at this time of year. I thought we'd be in the one that we'd hit, we'd stay in the 130s in the early part of this year. It just didn't come to pass. You can make the argument I didn't respect or appreciate the 4-year cycle as much as I should have. Having said that, I don't really have much skin in the game so far as Bitcoin is concerned, other than having an investment in the mining operation. But I am a buyer of IBIT. I've been trading IBIT shares, the ETF, for probably the last 3 months or so, doing quite well. I would be inclined, right? This is why I say I think you're getting great opportunity to test your wares when it comes to entering the crypto space, given this near 50% decline in Bitcoin price now, entering the month of February. And it's not about calling the precise bottoms. Who cares? Who cares? Do you have cash on the sidelines? Right. We're talking about how to be practical. Be practical with your cash. Manage cash wisely. Like, I came into this year with more than 50% in cash, looking for a first half correction in equities. But if you're going to give me a bigger bear market in crypto, I've got plenty of cash to throw around. I'll take 1% stake for each 1% down in Bitcoin, and hopefully we'll find a bottom near term, maybe around that 50% decline mark, and start the bull market again. Now, keep in mind it's a pretty big wave down again from there in the cycle forecast, but ends the year, I mean, on a really, and this looks like new all-time high levels. Again, the peak may not be a new all-time high precisely by the end of the year, because that's just the way cycle. But pay attention to the trend of the cycle forecast more so than the terminal and peak points. So I like it. I like the decline. If Monday I have an opportunity to buy IBIT maybe under $40 a share, you'll know what I'll be doing. So keeping it practical for Phenom Group members. This is our macro market research report. You have to be a contributor member or a premium member to get this directly in your inbox every week. So if you're not a contributor or a premium member and you want to get our macro market research, you want those practical ideas and tactical opportunities, subscribe. With that cheap pitch out of the way, if you will. I thought this funny too. When people used to say, right, Bitcoin is not equities, folks. Bitcoin's not equity. Bitcoin doesn't have fundamentals. Whoa, 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 whoa. Okay. Don't thumbs down me just yet. Tell me what the fundamentals are. Well, look at the adoption, Seth. Where? Where? By institutions that are setting up storage platforms, securitization platforms. That's not a thing. Adoption is not utility. That's, do you have Bitcoin? Do you want to store it with me? We can securitize it. We can collateralize it. I just want to go to 7-Eleven and get a Slurpee with my Bitcoin. I want to go to, a Stop and Shop and get groceries with my Bitcoin. Right? There's no fundamental. There never has been. I don't know that there ever will be. But we're creating all these different terminologies to basically assuage the facts. And the fact is, it's a religion. It's a belief system. And that's okay. I've never said there's anything wrong with that. What's wrong is when people fool themselves into thinking, there's something fundamental like there is with corporate earnings, right? i.e. the stock market. Like these are very different things. And to assimilate or assume, that NASDAQ had some kind of correlation with Bitcoin price action, you really had to be drinking from a ridiculous punch bowl on Wall Street. You did. Right. Oh, well, what about what's that? Blockchain. Good. Yeah, I get it. I get it. The whole blockchain idea, technological advancing of platform securitization. For every one company that goes on Bitcoin on the blockchain, two are getting off of it. It's too expensive and it's not transactional. There's just no scale. It's ridiculous. Everything you throw at Bitcoin, trust me, I've got an answer for. As a miner, that is my answer. There's no way in the world. Think about it this way, okay? So you have these mining operations. What are they mining? Bitcoin. What are they doing with that Bitcoin? They're selling it. Why the hell are they selling it if it's going to be worth so much? Right? Right? Do the math. You know how halving cycles work. And if you own a mining operation, you know how the impact from the halving cycle is on your mining operation, both from a cost standpoint and from the efficacy of your algorithms or your rigs. Like this has a terminal point when you do the math, and it's not that hard. It's why Michael Saylor has to do what he has to do. I don't want to get into that. I've gotten into it with our Phenom Group members. Like they know how the math works, and they know why Michael Saylor has done the things he's done in the past. I've shown the math. This is not because he wants to. It's because he has no other choice at this point. With that being said, again, what we can't deny is the religion. We can't deny that. That I said it's okay. And if the religion ends one day, it ends one day. But right within that religion is the understanding that Bitcoin goes up over time, right? Ether goes up over time. These crypto assets have gone up in value over time. Until proven otherwise, it's a reasonable investment thesis. Until proven otherwise. It may one day be proven otherwise. Whatever, I'll take my lumps then. Until then, I'm willing to participate as a miner and as an investor. Certain percentage of the portfolio, nothing more, nothing less. Moving on. And as the chart shows, the difference between, ProShares, Bitcoin, and the NASDAQ, this is the widest gap basically in the last 2-3 years. I only went back a couple of years. So. What else do I want to get into? So, I also had posted this chart on X to end the week, satisfying all the different S&P 500 sector ETFs performances year to date. As we can see, it looks like energy is the big winner, right? Last year's Bridesmaid is never a bride. Well, it's a bride right now, isn't it? Right? That was last year. It was one of the worst, if not the worst performer this year. I mean, complete bridesmaid transformation, right? What else? Let's see. Staples. Look at Staples, folks, up 7.4% just in the month of January. Now, the trend in Staples is something that I had actually recognized. Um, yeah, here's our full year 2026 Outlook report. We do all of our Outlook reports the end of November, the previous year. And our sector pick, if you will, one of our favored sectors for 2026 became staples, consumer staples. They have been an underperformer for 3 consecutive years. They had one of the best valuation profiles amongst all sector ETFs. Taken together, and just knowing some of the heavyweights in the staples sector were also underperforming, but probably setting low bars. We thought it was a reasonable probability to see at the base case, right? Some upside performance in 2026. The bull case would be market performance, and the most bullish case would have been outperforming the S&P 500 for 2026. Now it's 1 month in, and obviously it's outperforming the S&P 500, but 1 month does not make a year. Here's a chart going all the way back to last year, again included in our 2026 Outlook report. And what I thought it was evidencing at the time was, past resistance, support, support, support. I don't need to be punched in the face 3 times to know, I got to get away from this guy any more, than I need something to hit support and bounce off it sharply 3 times to know I got to get closer to this sector ETF. And so this was one of our, if not our top sector pick for calendar year 2026. Staples doing very well so far this year. Let's see. I'm bad with color. Industrials. So that's industrials up 6.7%. Very well. So not only did we get into consumer staples as an investment idea for the 12-month forward period, but Pepsi, right? Pepsi, we actually got into early last year. January 8, 2025 is when we started establishing our core holding in Pepsi through dedicated trading strategies. And so essentially we would, buy a lot of Pepsi, watch it go up 1%, take some off the board, get the opportunity to buy it again, the same lot size, watch it go up 1%, take some off the board. Each trade we're leaving some on until we get a fully weighted position out of 4 completed trading scalps or swing trades. And so we had been doing that all last year. Probably upwards of 25 individual trades. Once we established our core, and each time we're trading it for 1% profits. So we have a 1% core holding. We're looking for some kind of dip in shares, a pullback in shares. We'll buy another 1%. It goes up 1%. We'll sell that. And each 1% profit lowers our core cost average by 1%. You do that enough times, even if a stock goes nowhere. We did that 20 to 25 times last year. It's a 20+% return. You can see here 143 was one of the trade prices that we were buying and selling. 130s buying and selling, 129s buying and selling. All right, 120s buying and selling, 120s buying and selling, 20s, and then let's see, 130s again, some VXX in there. This year, buying and selling, 1, 2, 3, 4 completed trades there. One, two, three, four there already. So with our strategy, the 1% for 1% plus trading around a core holding strategy, probably now 30 plus trades. Why that strategy works so well? It's a proprietary strategy that I developed many years ago. When you look at the 1 year chart of Pepsi, that's the gain. From February here, February of last year, to what will be February of this year, Pepsi shares are up 1.1%. We have greater than a 25% profit on this investment idea. Again, we bought the dip, right? With the rest of the market. I mean, Staples dipped as well. Staples corrected massively. They kept correcting until July, even as the equity market was soaring by that time. And underperformance last year for consumer staples, underperformance for energy last year. Some of the biggest winners this year were last year's laggards. But it definitely got up and went the rest of 2025 and into this year as it's getting the flows from the sector itself. Keep in mind that some 85% of share price movement on individual stocks is predicated on the flows to the sector. A lot of folks will be like, why is my stock doing so bad? Why is my stock, they just had good earnings. What's going on here? Go look at your sector ETF. I can almost guarantee you your sector ETF is doing the same thing. And that's why your stock is doing what it's doing. Think about Apple. Apple had one of the best reports it's had probably in the last 2 years. The stock was up $1, $1 after it reported results. Now go look at the technology sector ETF, right? It's been one of the worst performers year to date, if not the worst performer year to date. Right? It's down 0.1% year to date. Right? Your stock is going to more than likely do what the sector ETF is doing. It can have gaps, don't get me wrong, and it can outperform the sector from time to time, but most of the fund flows for individual stocks are actually going to the sector itself. The bigger point that I was making, and I wanted to, we're not going to read every byline here in my macro market research report, but the biggest point I was trying to evidence is to Phenom Group members and now to the rest of the world here. I hope you're enjoying our video. I don't do a lot of these throughout the course of the year, is that you have to behave properly. Behave properly. If we think about, Pepsi last year, it had an underwhelming year. It had an underwhelming 2024 year, operationally, metric-wise. And so last year, we were looking for the probability. As an investment idea, we were looking for the probability that Pepsi would find a trough in operating performance. And it did. By the second half of the year, it found its bottom in operating performance and in share price. And so what do you do if you have a thesis, if you have an investment? And let's face it, this is Pepsi, folks, right? Right? This is not going bankrupt. This isn't a fly by night type of story or whatnot. This is a blue chip. This is almost better than Coca-Cola. Why do I say that? It's in the growth index, for crying out loud. It's in the NASDAQ. Coca-Cola is not in the NASDAQ. These are things to know, right? If you're trying to be a stock picker, you always want to look for growth. Coca-Cola is not in the NASDAQ. It's not a growth stock. If you're going to go for a consumer staple, you want it to be a growth consumer staple stock, like a Costco, like a Walmart, like a Pepsi. It just so happens that Pepsi, with the inflation surge in 2022, and then the normalization of that surge through 2025, We had a consumer that was pushing back on higher prices, trading down to private label brands. And the company had to go through that decline in sales in order to set a low bar. And that was our primary thesis, that it was going to set a low enough bar in 2025 for which 2026, which gets priced in the back half of 2025, right? 2026's projections or earnings estimates get priced well in advance of 2026 coming to pass. So that was our thesis, and it has worked out so far. Pepsi's finished also up 7% in the month, I believe 7% in the month of January. So it's even underperforming the sector, not by much, but it is. It's outperforming the S&P, it's outperforming the NASDAQ. Who had consumer staples as a top sector pick? It's not the top sector. I get it. Hey, you should have chosen materials. You should have chosen energy. No, you shouldn't. No, you ever shouldn't. Right? Just because something is the best performer doesn't mean you go after it. Doesn't mean you chase it. Right? Commodities, energy, gold, silver, metals. You should never go after those areas of the market as a primary investing discipline because they go nowhere forever. Forever. And they generally underperform. They can underperform for a decade at a time. Your career might be over by the time it comes back into favor. When people look at gold and silver finally having their quote unquote shining moment, right? People have long since died waiting for this. So that's why I say, as a discipline, you don't bother with commodities. You just don't. It's not a matter of, can I make money? Sure, you can make some money, but more than likely, you're going to underperform equities. That's just not the business I want to be in, even if they have their shiny moment, even if energy leads for a brief period of time. We were supposed to be in this super commodity cycle back in 2022. Remember, this was going to be the next commodity super cycle. What did it last? 6 months? There's no such thing as a commodity super cycle. People look back at the early 70s the 70s into the early 80s, and they just want that again. A sample size of one. You give it a fancy name, and all of a sudden people just believe in it. It becomes a religion. They've been waiting for this religion to come to pass again since basically the early 1980s. There's no such thing as a commodity super cycle. There's just a religion. Not saying it's wrong. I'm just saying I've never met anybody who consistently outperforms equities by investing in commodities. So anyways, the behavior, right? If you were buying, which we were, right? We were buying Pepsi during the whole Liberation Day bear market thing. We were buying and trading our 1% for 1% profits throughout the troughing period here in Pepsi. And we were buying as it was surging during different periodic pullbacks. It's about behavior. What's practical? It doesn't matter what I tell you. It doesn't matter the insights that you gather here or wherever, what books you read on investing and trading. What matters is what you do. If this is a 1-year performance and it's only gained 1.1%, if you are a buy and hold and then wait, this really sucked. This was a sucky investment idea. This is why you manage cash wisely. This is why you actively manage a portfolio, so that if you have a thesis, you better have conviction in that thesis. If you're getting cheaper prices for the same thesis and the fundamentals are basically telling you your thesis is solid, why not take advantage of cheaper prices? Just keep buying. Now, I generally only say that for index and sector ETFs, industry ETFs. But what I do is what I've done and demonstrate with our Phenom Group premium members. They get all these trade alerts as in real time. And you can do the same thing with the index, right? This chart, right? This is our graphic. This is from back in April and May of last year, right? We hit the 10%, right? This is a 10% decline for the S&P 500, 10% decline. Start buying. Start buying. We had a full correction, 10% garden variety correction. Market bounced around, even rallied, and everything fell apart. Every 1% lower than the 10% threshold, just keep averaging in, just keep cost averaging in. Index ETF, the spider, the Qs. Add 1% for every 1% drop in the Qs, every 1% drop in the spider, every 1%. Gets down 20%. You had your technical bear market, right? You want your bigger position to be at the bottom. I didn't know in real time that this was the bottom. I actually did, and I wrote about it. But for argument's sake, we don't have time to go through it. So for argument's sake, let's just say I didn't know it was the bottom. So I had a threshold. I had a mile marker, and that's 20% to add the bigger weight. And then the market rebounds, 10% off of that 20% level. So you're right back to where you started here. Everything here on an equal weighted portfolio, your break even. Remember, the market is still down 10%. But because of how you behaved, because of the actions that you took, because of the practicality of active portfolio management, having a game plan, you're flat on the year. Your portfolio is flat. Just an index ETF investor, your portfolio is flat, while the index is still down 10% from the all-time high. It's still down 10%. That's why I say it's what you do. Your portfolio does not have to equate to the S&P 500 being down 10% still, any more than your portfolio owning Pepsi had to only gain 1.1% over this 1-year time period. What you do matters. Practicality. Here's another example. I want to show you this real quick. As usual, I don't plan these videos out. So, Ryan does great work. So don't take this to be anything more than a good opportunity to demonstrate. All right. So tech, healthcare, and financials all lower in January. Most investors own a lot of those three, yet other areas did really well. Industrials up nearly 7%. Not bad. Stay diversified is our bigger take. Why did he mention industrials and not mention consumer staples? Now, another reason why I say don't chase energy, don't chase materials, don't chase industrials. These are very consumer cyclical. They're very economically sensitive areas of the market, economically sensitive sectors, industries. They're not necessarily growth independent, right? They have too many different companies that don't dominate, which is the exact opposite of, let's say, the Magnificent Seven, tech, semiconductors, right? The Qs, they're as concentrated. The Qs are the most concentrated for a reason. They have the most dominant companies, not just in their industry, in the world. They're going to come back and be leadership. It's just a matter of when. So for this moment in time, You're chasing the performance in industrials, materials, energy, which are very economically sensitive, as opposed to the other areas that I mentioned, which are less economically sensitive and have a greater monopolistic share of their industry as well as international exposure. Stay diversified is our bigger take. That's my biggest problem with this post. Why? Diversification is good as a portfolio flattener, right? Essentially, if the market goes down, but you're well diversified and you got a good mix of assets between the different asset classes, maybe you got some commodities, maybe you got some bonds, treasuries, and you got some equities, and you got cash, right? That's kind of the all-weather portfolio, which was essentially created by, I forget, Ray Dalio of Bridgewater, right? He created and named it the all-weather portfolio. It's got a variety, a huge mix of different assets. Over the lifespan of the all-weather portfolio, it has underperformed the S&P 500, just the S&P, by more than 50%. Diversification is good for reducing the volatility in your portfolio. It's not good for market performing results, let alone outperforming results. So what are we really doing here when we diversify? And by no means am I saying don't diversify. I'm trying to make that clear as well. I'm not telling you not to diversify. What I'm saying is have the right expectations if you choose to do so. If you're looking to outperform the market, you need to be in areas of the market that outperform predominantly in your portfolio, not equally as it pertains to other assets, other areas of the market. You can't market perform that way, let alone outperform. The main benefit of diversification is the flattening effect of the portfolio, i.e. the reduction in volatility of the portfolio's performance. Market may go down 20%. Your portfolio may not, because it's well diversified. It may only go down 10 or 15%. The problem is the upside, right? The market can go up 30%. Your portfolio, well diversified, but it may only go up 15%. You got to know who you are as an investor and what you're looking at. What are your goals? That's what matters most, right? If your goal is to actually minimize, volatility, because you know yourself, right? You know you're an easy sell. You're going to sell when things are bad. Okay, well, if your portfolio is not doing that bad because it's well diversified and it's only the market that's doing worse, okay, that works for you, right? That diversification has worked for you. You know yourself. But if you're actually looking to outperform the market, diversification is actually your enemy. You need to have a concentrated portfolio, more than likely concentrated in the growthy areas of the market. You are going to have or suffer more volatility than the diversified portfolio, but you're also going to achieve the greater returns. At the end of the day, you have one question. Are you worried about your drawdown or the actual returns? Right? I mean, nobody gets a knock at the door saying, hey, here's your trophy for taking a small drawdown. Like, that doesn't happen. You don't get paid for taking a lesser drawdown. You know what you do get? A lesser drawdown. That's it. All past declines look like an opportunity. All future declines look like a risk. So says Morgan Housel. I love that because it's the reality. In hindsight, right? In hindsight, this looked like beautiful opportunity. But in the future, this is the risk people are fearful of. Hindsight, it looks like opportunity. In the future, it's what people fear. You've got to undo that psychology. Find a way to undo that psychology. That emotional quotient does not work for outperforming results. It does not work. You got to get to a place where, Oh God, I hope this market falls apart. I hope it drops 20% because bull markets are built, constructed, cemented on the backs of bear markets. The greatest opportunity comes from down, not up. But trend following strategies tell me otherwise. Trend following strategies underperform the market. Trend following strategies underperform buy and hold. Go look at the data, folks. All right. A lot of our quant work here. Don't need to get into too much of that. You've seen some of it in my X post. So let's see what else I want to touch on. Just again, speaking to analogs, I'll throw these out there as well on X. Magnitude is not precise. Okay, it's about the trend, the path. Midterm years versus all other, in the 4-year presidential election or 4-year presidential cycle, the midterm year is the most volatile and has the lesser returns of all the 4 years in a presidential cycle. This one, shows a decline into February, but also a rebound around Valentine's Day, and it just keeps making higher highs for the year. Another nice pullback into April and surges into May. If there ever was a time where sell in May and go away typically has a greater efficacy, right? More practical, it is the midterm election year. It is more practical. Historically, it shows up in the return results going back to 1950 as a more practical approach in a midterm election year. By no means am I telling you to sell in May and go away because you'll be selling to me, right? If the market does decide to decline, you will be selling to me. I'm a buyer. I'm a buyer of cheaper prices. If you don't know that about me yet, I am a buyer of cheaper prices. I am a shorter of higher volatility. Give me volatility all day. That's my Super Bowl, speaking of, right? That when I see higher volatility, that's like the Super Bowl for me. That's like Christmas to me. So that, again, a mindset. You've got to have, to outperform the market, you got to have the mindset. People like to castigate and poke holes at the short volatility investment thesis because it is an investment strategy. It's my primary strategy for the Golden Capital portfolio as implemented since 2012. These are the returns for VXX alone. This is an unleveraged. This is not like a UVXY or a UVIX that's 2 times leveraged the VIX. This is just VXX, which is 1x leveraged to the VIX. And you can see, returns. This is going back to last year, but this is, 5-year performance, 52%. 3 years, 51%. 1 year, right? I mean, this is how you beat the market too. And again, your results don't even have to equate to this. You see me on X, you see all the trades, you see them in I'll go to the Phenom Group private X page where the trade alerts, as well as on Telegram. We issue them on both X and Telegram to our members, right? I mean, these are all of our trade alerts. I mean, VXX shows up the most. We probably do 150 to 175 profitable because they all come clean. They all produce their profit. No stop losses, things like that. It's all about position size. As I often say, hey, I'll enter a short. This was a second position because the first one was still on the board. So we always go into our short volatility trades thinking, right? Our mindset is it's going to go against us 10, 20, 30% because that's how fast volatility can move, let alone the derivatives in the volatility complex. So it's always about small position sizes so that you can afford the opportunity to short at even higher levels. But we'll do, these all year long. Pepsi, we've had some Apple, XLV Healthcare because we're long-term shareholders in the healthcare sector ETF, VXX, right? This is our bread and butter. This is easy money. This is guaranteed. People say all the time, there's no guarantees in the market, and history is not a guarantee of future results. They should complete that sentence by saying until proven otherwise, because that's the reality. The S&P 500 goes up in time. That's a guarantee. Historically, that's a guarantee. What are you talking about? History is not a guarantee of future results. That absolutely is. The Qs go up over time. Bitcoin has gone up over time until proven otherwise. History is not a guarantee of future results. It's the same thing with the short volatility trade. It's absolutely a guarantee. You just have to know how to position size. And another nuance is have a good macro market, macroeconomic background, because you do want to, if things get rocky in the market, but I will also recognize, what did I do with it? 2022, the short volatility trade was a better performer than the S&P 500. Right? The VIX is not the S&P 500. It's not a perfect inverse of the S&P 500 either. One goes up, one goes down does not always play out. It's about an 85% inverse correlation. Let's see what else. So here's another one of the analogs that we've been tracking. This is from DataTrek Research, great firm. NASDAQ comp 1,000 trading days post the 1995 versus 2023 to present. And so we're basically right here in the dot-com era. You can't deny it, right? To deny it is, kind of foolish at this point. This was the starting point of the analog from 1995. And again, sometimes magnitude is the only difference. But the peaks, the valleys, they're almost perfect. Almost perfect. This is another one where magnitude, right? We are down a little bit and chopping around here near all-time highs. So maybe we don't have the bigger plunge like the Asian financial crisis. Maybe. We do have a lot of geopolitical issues and domestic political issues that investors are forced to contend with. So you keep an open mind. But if not, no wonder we don't get the bigger dip. So another analog that we're following, and this is, of course, the cycle composite for 2026, which did, we saw the liftoff almost precisely. But keep in mind that this is a composite, right? So it has the decennial cycle average. It has the 1-year monthly cycle average. It has the 4-year presidential cycle average, all combined into one cycle composite average path, which evidences or guides to higher highs as the year carries forward. So when people say, well, which one is it? It's all of them. These are guides, right? They're not guarantees. These are not guarantees. They're guides. They're a rough average. When they falter, don't throw them away either, folks. Why? Because this faltered at the very beginning of the year. It faltered all the way through Liberation Day for last year. But look at how it got right back on path. You could make the argument that it faltered here, October through November, but it got right back on path into the end of the year. And that's the main reason why, yes, you recognize that these are not perfect, right? It's not a perfect representation of what you should expect, but rather a guide, and why you don't throw it away when things aren't, necessarily, the current year is not necessarily in lockstep with the composite for the year. It all comes down to earnings. I know we kicked off this podcast by talking about, going through a liquidation event, and that's what I, basically would label the current, intermarket environment, right? Whether it's metals, crypto, and equities, it's an intermarket liquidation event and environment. But that's the best. The if the equity markets, if stocks, if the S&P, if the Nasdaq want to pull back to a greater degree because of the hunt for liquidity due to the sell-off in metals and in crypto, you couldn't ask for anything better as it pertains to lower equity prices. The last time I said that was with respect to the former government shutdown. Why? Because you know what's going to happen next. The government's going to reopen. It's not going to stay shut down forever. This is a known. The only thing that's unknown is when the government would reopen. So we had some choppy days the last time the government shut down, and it became the longest government shutdown in history. It didn't detract from that fact that the government had to reopen eventually. And so if that's why the market had those choppy and volatile days there, the last government shutdown, it's the best reason to buy stocks at cheaper prices. If it doesn't have to do with the actual corporate fundamentals, you buy the dip. You buy the dip. To the extent that people, they want to absorb materials, information flow, media content, that basically promotes, pessimism and negativity around the economy and the market, because you think paying attention to that stuff will help you to avoid such calamity in the market. That's the wrong framework for which to perform due diligence. Right? The media, listening to media or social media, certain social media accounts, that's not due diligence, right? That's not practical. Buy and hold is the number one strategy ever and still. Why? Because you are guaranteed not to miss a single tick in the S&P 500. Headlines that induce fear and force you to hit that sell button are not going to help you hit the buy button at the precise time for when the market bottoms and starts heading higher. Hence, if all you did was buy and hold, you get every tick. Sure, you get every downside tick, but what does that matter? Nobody's giving you an award for taking a lesser drawdown. Hold on, manage cash wisely, buy at cheaper prices. The S&P 500 follows earnings over time. The correlation is 98%. I mean, I'm not in the business of following data that lies. This data doesn't lie. If earnings are going higher, equity prices will go higher over time. Maybe not even in the same calendar year, but again, that's your opportunity. Right? We have a bear market. Think about 2022. Were earnings down? Nope. We had a bear market in 2025. Were earnings down? Nope. So buy and wait. Sometimes that's the hardest thing for most people to do is the wait. They want to see things change in their P&L in the minute, on the moment, day by day by day. Again, that's a behavioral problem. It's discipline. It takes discipline, to be patient and wait for the turnaround. Or don't be patient. Have a game plan. If you know you're not a patient person, that's more of a cue that you need to, it's a signal, a red flag that you need to start formulating a game plan. Spend your time wisely. Formulate a game plan, then execute the game plan. That game plan should always be about buying. Now, in our report, we talked about earnings, and we take the data from FactSet. They do a fantastic job kind of reiterating where we were just a couple weeks ago. So let's take a look at how the earnings season is evolving to date and nearly halfway through the Q4 reporting season. For the Q4 reporting season, this is what was being tracked by FactSet just last week. And I go to S&P 500 was being tracked at 8.2% earnings growth for the Q4 period, revenue growth of 7.8%, both pretty much in line with the estimates from December 31st or the end of last year. Now, the complete year 2025, that was tracking 12.4%, again, in line with the end of 2025. 2026 at 14.9%, which is always going to come down. That comes down, at the beginning of a new year, no matter what, but just as a reminder. So in here was the complete year, 2026. This was 2 weeks ago when we were at 310. So complete year 2026 and complete year bottoms up EPS. Bottoms up, 310.95. I don't care about this right now. I'll care about this in the back half of 2026. I don't care about 2027's estimate right now. I care about this one. The equity market is still pricing 2026 in the first half of 2026. So this was 310.95 for the full calendar year, representing about, we'll call it 14% year-over-year earnings growth for round number sake. Fast forward, starting with Q4 tracking to date, right? We're back to the Q4, and we've jumped up to 11.9%. Halfway through earnings season, 11.9% year-over-year earnings growth. Remember where we came from. 8.2%. Jumped up to 11.9%. All right. Revenue revenue 8.2% versus 7.8% last go around. I mean, revenues, you should have kind of that clock going. Now complete year, right? So we just looked at the Q4 revision, or tracking, significantly higher. What about complete year 2025? 13.2% versus the former 12.4, almost a full percentage point higher than the estimate coming into earnings season. It's going to be. We still have Alphabet, Amazon, Nvidia to report, Avago. Like, this is going to be higher. If not, closer to 14.5, I would think. Closer to 14.5 for the full year 2025. Net profit margins. 13.2% is what it's tracking now versus the estimate for last year at 12.7%. Q4 2024, Q4 2025. A half percentage point greater. And this is going to go up as well. These are all-time highs, all-time high profit margins. All-time high profit margins, folks. It's a lot of free cash flow being thrown off. Good stuff. Good stuff. Now, the tracking, the bottoms-up model, right, for 2026 is now 311.12. What was it that we just mentioned before? 310.95 or 310.96? Now it's 311.12. Likely to go higher over the second half of the Q4 earnings season, as it's, you're seeing so much greater performance than the estimate that carries through into the estimate for the full year, the next year, i.e. 2026. So that's a look at what's going on with earnings and relating it to, the prior subject matter of how you behave. You see what's going on in crypto over the weekend. You saw Thursday and Friday's market performance. What should you be doing given the reality of earnings estimates? and realized earnings already here through the Q4 period. And I remember, folks, this was the estimate, right? This is 2024 and 2025. 274, right? 274. There it is. First week of 2025. That's where it started, folks. 274 for calendar year 2025. We're ending closer to 280. All right. Now, last thing up, and then I'll let you go about your business. You don't have Super Bowl this weekend, so I wanted to look at technology, right? It's down 0.1% this year. I own tech stocks, right? I own the Qs in the Golden Capital portfolio. I own the Qs. I own to a lesser degree now because I've been selling off my Nvidia shares over the last year. But I do still own Nvidia, and I have a overweight position in Apple. I mean, these are the two most heavily weighted stocks in the technology sector ETF, ticker symbol XLK. So how is technology doing so far in the earnings season, and what is that projecting for 2026? Well, technology is outperforming in the earnings season, and the estimate has gone up. It now has a 3 handle, folks. They're now expecting complete year 2026 earnings growth for the technology sector to come in at 30.3%. Remember, you still have Avago, you still have Nvidia to report. It's the highest growing sector on a year-over-year basis in the S&P 500. It's the worst performing one of the worst performing sectors year to date, and it's in the red year to date. So the question is, what should you be doing? And what are you thinking? Last year, the technology sector actually had a flat multiple year over year. Do you think it's going to go 2 years in a row with no multiple expansion and even greater, a 30% year-over-year earnings growth? Yeah, okay, stranger things have happened. I get that argument, but that's not about probabilities. That's about black swanning stuff, living in fear, right? You can't invest that way. You got cash on the sidelines, you got to put it to work. You don't get paid to be afraid. And if you are afraid, then just do it afraid, but do it anyway. I'm going to be in the business of buying tech. I'm already overweight Apple, but I'm looking to get more overweight. I'd like to get up to a roughly 3% weighting in the Golden Capital portfolio right now at roughly 2.5%. That's a significant holding for me. I'm okay with it. Company just reported great results. Doesn't mean it's going to land me in, greater returns. But the probabilities point in that direction. All of our technical work. And ending, reiterating, right? This week's macro market research report was one of our more practical research reports of the calendar year to date, right? We haven't had that correction. Biggest pullback that we've had basically since Liberation Day was 5.1%. My outlook for the first half of 2026 is to experience a full 10% correction at least. Now, I'll be happy if it doesn't come to pass because it means I'm still making money and I'm always long anyway. Maybe I'll be a little bit discontented if I can't put more capital to work because I do have an ample amount of cash on the sidelines, or cast a wide net. Maybe Bitcoin becomes a bigger part of my capital allocation in calendar year 2026 if it is the asset class that demonstrates that full correction, if not bear market, before equities have a full correction. Cast a wide net. So I hope you enjoyed our weekend video here. And if you have any questions, don't hesitate. You can reach out to me directly in the socials. But I would encourage you to if you want our macro market research reports, as well as our 2026 outlook report, and access to all people. Somebody had written in the past, you could have just made that chart to make it look like you guys were buying back in the bear market of 2025. Here's our May 2025 report, and I'm sure there you go. If I say I'm one of those practice what he preaches kind of guys. Enjoy your weekend, folks.